As a business owner or financial manager, you're likely familiar with your profit and loss (P&L) statement. This document gives you a clear view of your company's revenue, expenses, and profit over a specific period. However, the P&L statement often fails to capture certain hidden costs that can significantly impact your bottom line. These hidden costs may not be immediately visible but can compound over time, potentially leading to financial strain if not managed properly. In this video, we'll uncover the top 10 hidden costs that don't show on your P&L statement and explore how they can affect your business's financial health. 1. Employee turnover costs. Employee turnover can be one of the most expensive hidden costs for businesses, but it often doesn't appear directly on your P&L statement. When an employee leaves, the costs go beyond just paying for the recruitment of a replacement. There are costs associated with training new hires, lost productivity, and even the impact on team morale. These expenses can accumulate over time, especially if turnover is high. While you may account for salaries and wages, the true cost of employee churn is often overlooked until it becomes a significant issue. 2. Outsourced services and contractor fees. Many businesses rely on outsourcing certain tasks, such as IT services, marketing, or administrative work. While contractor fees are generally recorded as expenses, the full scope of hidden costs can be much larger. For example, the business may incur additional costs for management oversight, quality control, and integration efforts with in-house teams. Moreover, depending on the contract, businesses might face unexpected charges for overruns, additional work, or changes in scope that aren't captured in the initial budget. 3. Inventory shrinkage. Inventory shrinkage refers to the loss of products due to theft, damage, or errors in inventory management. While some of these losses may be recorded as write-offs or adjustments in financial statements, they often aren't reflected as a direct expense in the P&L. Shrinkage, especially in retail businesses, can lead to significant financial losses if not carefully monitored. If theft or inefficiency in stock management is a recurring issue, it can quietly drain your profits over time without being fully accounted for in standard financial reports. 4. Legal and compliance costs. Legal and compliance costs are another set of hidden expenses that may not show up in your P&L statement. While specific legal fees related to contracts, litigation, or regulatory compliance might be recorded, many ongoing legal costs, such as maintaining licenses, adhering to industry regulations, or covering settlement costs, may not be immediately visible. These costs can grow over time and become a serious burden if not proactively managed. Additionally, failure to comply with regulations could lead to fines, penalties, or damage to the company's reputation, all of which have long-term financial implications. 5. Depreciation on assets. Depreciation is a standard accounting practice that allocates the cost of tangible assets over their useful life. While depreciation is included in the financial statements, it's often underestimated in terms of its real impact on cash flow. For example, replacing or upgrading old equipment or machinery can become a significant expense, especially when the asset reaches the end of its depreciation schedule. The cost of maintaining or upgrading these assets might not show up directly in the P&L until the equipment fails or needs a substantial investment, which can strain cash flow and impact long-term financial health. 6. Lost opportunities due to inefficiency. In many businesses, inefficiency in operations, production, or management can lead to lost opportunities. For example, poor customer service can result in lost sales or missed chances to expand into new markets. While the cost of inefficiency isn't always reflected directly on the P&L, its impact on growth and profitability can be significant. The loss of business opportunities, such as customer churn or delayed projects, can limit a company's ability to grow and create revenue streams. As inefficiency compounds over time, it can result in substantial financial setbacks, even if these losses aren't immediately visible. 7. Interest on debt. While interest payments on loans are often accounted for in financial statements, many businesses overlook the long-term impact of their debt. High interest payments can take a significant portion of your earnings, reducing the amount available for reinvestment in your business. Additionally, businesses with substantial debt may face higher financing costs, limiting their ability to pursue growth opportunities. The full impact of interest payments, especially compound interest over time, may not be fully appreciated unless it's clearly tracked and assessed in the context of overall financial health. 8. Customer acquisition costs, CAC. Customer acquisition costs, CAC, are a vital metric for any business, especially those with significant marketing or sales efforts. However, the full cost of acquiring customers is often understated. While marketing expenses are listed on your P&L, CAC includes not only direct advertising costs but also the time spent by sales teams, incentives, follow-ups, and other indirect costs. If these expenses aren't closely tracked, they can accumulate and eat into profit margins. Poor customer retention rates can further increase CAC, making it harder to generate a positive return on investment from marketing activities. 9. Brand reputation management. Brand reputation management is another hidden cost that doesn't always appear on your P&L statement. Negative reviews, social media backlash, or poor customer experiences can harm your brand's image and result in lost sales. While the direct costs of responding to customer complaints or implementing reputation management strategies may show up in your financial reports, the indirect costs, such as lost trust or a diminished market position, are more challenging to quantify. A tarnished reputation can result in lower customer loyalty, reduced sales, and difficulty in attracting new business, ultimately impacting the bottom line. 10. Technology and software upgrades. Many businesses rely on software and technology systems to run their operations efficiently. However, the hidden costs of maintaining, upgrading, and troubleshooting these systems can be substantial. While software subscription fees may be listed in the P&L, the long-term costs of upgrades, system downtime, or additional IT support aren't always fully reflected. As technology evolves rapidly, businesses may face the need to invest in new systems or infrastructure to remain competitive. These costs, often overlooked until they arise, can strain cash flow and take a significant toll on profitability if not planned for properly. Hidden costs can accumulate over time and chip away at your bottom line, leaving you with a distorted view of your business's financial health. While the P&L statement provides valuable insights into revenue and direct expenses, it often fails to account for the indirect costs that can significantly impact long-term profitability. By understanding and monitoring these hidden costs, ranging from employee turnover to technology upgrades, you can make more informed financial decisions, improve efficiency, and protect your business from unexpected financial strain. Proactively managing these costs and accounting for them in your business strategy is essential for ensuring long-term financial success.